Hi everyone, I'm Sapna Ravishka, and today through this video I'll be explaining to you all the cost volume profit analysis, CVP analysis. Okay, yeah. So now first of all, to start with, let's identify the two time frames in decision making: short-term decision making and long-term decision making. So short-term decisions are taken by the managers in order to solve the operational problems in a business organization. So these are the day-to-day made decisions, or routine decisions. So the strategic managers' involvement in these type of decisions are relatively less, whereas the operational level managers' involvement in these type of decisions are much higher. So it's basically the operational level manager's responsibility to engage with this short-term decision making. Okay, so the technique used in short-term decision making is marginal costing, and we also call that as cost volume profit analysis. So when we take this term cost volume profit analysis, it consists of three subsections: cost, volume, and profit, and each of these elements are interrelated. Now, why do I say this? With correspond to the changes in cost and volume of products, profits of the business organization will be changed. Of course, yes. So when we change our production volume, it will automatically change our costs, and it will ultimately change our profits as well. So therefore, it is essential to evaluate the cost behaviors in short-term decision making. And another important point to be noted here is under short-term decision making, when we reach our conclusion, we place a higher weightage on contribution rather than on profit. So what is the difference between contribution and profits? It is the total fixed cost. So under short-term decision making, we make an assumption. We assume that total fixed cost will remain constant over the time period. So that is the basic reason why we are placing our weightage on contribution rather than on profits when we are making decisions under short-term decision making. Okay. And nextly, let's focus on these cost behaviors. So what are cost behaviors? Cost behaviors are the changes of cost according to some of the quantitative differences. So under this, what we focus is how different types of cost elements change with respective to changes in production volume. Okay. So here we are focusing under four types of costs: fixed costs, variable costs, semi-fixed costs, and semi-variable costs. Okay. So first of all, let's look at the fixed costs. So fixed costs are the costs that do not change with correspond to the level of production. Okay. So total fixed cost is constant over the production level. So here the horizontal axis is the quantity axis and the vertical axis is the cost axis, or the rupees. Okay. Here we can say that total fixed cost is constant amount over the different levels of outputs. Okay. That is why you can see this flat curve. Total fixed cost is a flat curve. And per unit fixed cost will decrease with correspond to the increase in the volume. So what is the formula to calculate the per unit fixed cost? Total fixed cost divided by the quantity. So the numerator, total fixed cost, we assume it to be a constant, whereas the denominator is the quantity. So when we increase the denominator, whereas the numerator is a fixed amount, what will happen to the answer? The answer will automatically decrease. So that is why you can see this fixed cost curve is gradually decreasing. This is the per unit fixed cost, which is gradually decreasing with respective to the increase in volume of output. Okay. But this remember this fixed cost curve will never touch this horizontal axis, which is the quantity axis, meaning which at zero level of output also there will be a certain per unit fixed cost which have to be covered. Okay. And then the variable costs. So when we take the variable costs, we can identify that in contrast to fixed cost, variable costs change according to the production level. Okay. So total variable cost will change according to the level of production. So here, if we look at the total variable cost curve, it is an upward sloping line. And it is starting from zero itself, meaning which at zero level of output at zero level of output, there will be no variable cost. And with correspond to the increase in the output level, total variable cost will increase proportionately. That is what is meant by this upward sloping line. Okay. And the per unit variable cost will be a constant over the production level. So here, if we take this, how do we calculate the variable cost? Variable cost we can calculate by dividing the change in total variable cost over change in quantity, or simply total variable cost over quantity. Okay. So if we take the total variable cost, it will also increase proportionately with correspond to the increase in quantity or output. So the numerator is also proportionately increasing, denominator is also proportionately increasing, meaning which the answer or the variable cost per unit will be a constant. So that is why you can see this flat curve, which is parallel to the horizontal axis, meaning which variable cost per unit will remain constant over different levels of output. Okay. And then let's focus on the semi-fixed costs. What are these semi-fixed costs? So let's focus on this curve first. So assume that so let's take an example, electricity bill. So how do they charge? Yeah, from 0th unit to the 100th unit, let's assume that they're charging 5 rupees per unit. So the moment you pass the 100th unit, the cost will gradually increase. So from the 100th unit to the 200th unit, we say we can assume that they are charging something higher than 5 rupees, maybe 10 rupees. So from 100th unit to the 200th unit, yeah, they are charging 10 rupees per unit. The moment you pass the 200th unit here, the cost will again gradually increase. So that is what is meant by this semi-fixed cost. We also call this as step cost, step fixed cost. Okay. So the cost which varies part by part when the activity level differs. For example, you can take that electricity bill scenario that we discussed here. So this semi-variable costs. So this semi-variable costs consist a component of fixed cost as well as a component from variable costs as well. So here a while ago we discussed that total variable cost line is starting from 0, meaning which there's no variable cost at 0 level of output. But in contrast, this semi-variable cost line is starting somewhere above 0. So what is the difference between this 0 and this touch point? It is the fixed cost. Okay. And this upward sloping line shows you the amount which is varying proportionately with correspond to the change in output. So this is the variable cost part and this is the fixed cost part. Okay. Costs which include a part of variable cost and a part of fixed cost. So for example, we can take the telephone bills. So in a telephone bill, if you carefully identify, they're charging a monthly fixed rental plus a varying amount based on your usage, talk time. Okay. So that is an example for semi-variable costs. Okay. And then let's focus on the marginal cost. So what is marginal cost? Marginal cost is the cost of producing one additional unit of output. Okay, we also call that as variable cost. So what is the formula to calculate the marginal cost? Change in total cost divided by the change in quantity. So if we take this small example, we are given with the quantity levels, fixed costs, total variable costs, and total costs. So how do we calculate the marginal cost in this situation? Okay, so remember that marginal costs we are calculating in between two levels of output here. In between 0th level of output and 100th level of output only, we have calculated this marginal cost. Okay, so from 0 to 100, the movement from 0th output to the 100th output, what is the change in total cost? 1000 to 2000, 1000. So change in total cost is 1000, change in quantity is 100, which will give you the marginal cost as 100. So that is how you calculate the marginal cost. Okay. And this marginal cost, we also call that as variable costs, which will consist elements like direct material, direct labor, direct other, and variable overhead. So remember, when we are considering this variable overhead, we have to consider both production variable overheads and non-production variable overheads. Okay. Then let's move on to the contribution. So contribution is the difference between selling price and the variable costs. Okay, so what do you mean by this contribution? It is the contribution to cover the fixed costs. Okay, so how do we calculate this? Contribution equals selling price minus variable costs. Okay, in terms of total figures, it is total contribution equals total sales minus total variable costs. Okay, so here there's a small example. Total sales is 1000, total variable costs is 500. So sales minus variable costs will give you the contribution as 500. Okay. And then let's move on to the profits. So what are profits? It is the difference between the fixed cost and the contribution. Okay. So the gap between contribution and the fixed cost, we name it as profit. So how do we calculate it? The difference between total income and total expenses. Another name for total income is total sales. And another name for total expense is total cost. Okay. So when we break this total costs into two components, we can identify total variable costs and total fixed costs. Okay. So we can rewrite this equation: profit equals total sales minus total variable cost plus total fixed cost. Okay. And then we have the, in the previous slide, we discussed the equation for contribution, which is total sales minus total variable costs. And both these elements we can see in this question, this equation as well. Okay. So total sales minus total variable cost. So when we substitute the term contribution here, we can rewrite this equation as profit equals contribution minus total fixed cost. So that is the formula to calculate the profit. So let's have a look at this example. So we have the selling price as 200, direct material 15, direct labor 25, direct other expenses 10, total fixed cost 40,000, quantity 10,000 units. Okay. So how do we calculate the variable cost? So variable cost equals direct material, direct labor, and direct other. Okay. So yeah. So we have to get the addition of these three. It is 50. Then what is the contribution? Difference between selling price and variable cost. So selling price is given as 200 and variable cost we computed 50. So 200 minus 50 is 150. And how do you calculate the total contribution? This per unit contribution into number of units, 1000. So 150 into 1000, 150,000. Okay. And how do you calculate the profit? It's the difference between total contribution and total fixed cost. Total contribution we computed 150,000 under this, and total fixed cost is already given as 40,000. So difference between these two is 110,000 of profit. Okay. And yeah, the next one is profit volume ratio. So what is this profit volume ratio? It is when the contribution is calculated as a percentage of sales. So this definition itself gives an equation. So contribution over sales into 100 will give you the profit volume ratio. We also name this ratio as contribution to sales ratio. Okay. In terms of total figures, total contribution divided by total sales into 100 will give you the PVR. Okay. And the variable cost ratio is also one of such similar concepts as PVR. So variable cost is calculated as the percentage of sales. Okay. So when variable cost is calculated as a percentage of sales, so again the definition itself gives you the equation: variable cost over selling price into 100. In terms of total figures, total variable cost divided by the total sales into 100. So there's an important relationship in between PVR and VCR. Okay. So what is the formula for calculating PVR? Contribution over sales. So contribution over sales is PVR. VCR, variable cost over sales price. Okay. So when we add these two fractions, contribution over selling price plus variable cost over selling price will give us selling price over selling price. That fraction will give you the answer as 1. So when we add the numerators, it will be contribution plus variable cost, which will again be equal to selling price. In the denominator also you have the selling price. So selling price over selling price, we can take it as 1. So that is the relationship between PVR and VCR. Addition of these two ratios must be equal to 1. Okay. And then let's have a look at this example. So selling price is given as 100, total fixed cost is given as 20,000, variable cost is given as 40, number of units are given as 1000 units. So how do we calculate the contribution? Difference between selling price and variable cost. 100 minus 40 is 60 here. And how do we calculate the profit? Total contribution minus total fixed cost. Yeah. We have the unit contribution. So this into number of units will give you the total contribution. That minus total fixed cost is given here. So that minus 20,000 of total fixed cost will give you the profit as 40,000. Okay. And then how do we calculate the PVR? contribution of sales price into 100. So we found the contribution as 60. So 60 into what is the selling price? 100. 60 divided by 100 into 100 will give you the PVR as 60. Profit volume ratio as 60. Then how do we calculate the VCR? VC divided by selling price into 100. Variable cost divided by the selling price into 100. So what is the variable cost? Given to us as 40 divided by selling price 100 into 100 will be 40. So here you can clearly understand this relationship through this example. 60% plus 40% will be equal to 100% or 1. Okay. Yep. PVR plus VCR should be equal to 1. Okay. And the next one, break-even analysis. So it is the study of changes in profit which correspond to the changes in cost and volume. Okay. Yeah. So break-even point is the situation where the business exists without a profit or a loss. So it is a no profit, no loss situation where the total costs of the business will be equal to the total revenue. Yeah, total income equals total expenditure. So total sales equals total cost. Total cost we can break down into two as total variable costs and total fixed costs. Okay. And then total sales. When we take this total variable cost component into the left side of the equation, total sales minus total variable costs will be equal to total fixed cost. So what is the difference between total sales and total variable cost? It is the total contribution. We understood it a while ago. Total sales minus total variable cost is the total contribution equals total fixed cost. So break-even point is a situation where contribution equals to the fixed cost. Okay. So this contribution we can break it down into two: unit contribution into number of units. So when we subject this number of units, we can rewrite the equation as total fixed cost over unit contribution is the break-even number of units. So this is the formula for calculating break-even number of units. Okay. Yeah. Then let's focus on the sales value of BEP. So a while ago we understood how to calculate the break-even point of units for break-even. Okay. So what is the sales value of these units? That is what we are calculating under sales value of break-even point. Okay. So break-even sales value equal break-even point in units into selling price. So the units that we need to produce or sell in order to break even, that into selling price will give you the break-even sales value. Okay. And the break-even sales value, another formula is total fixed cost divided by PVR ratio, or total fixed cost divided by the CS ratio. Okay. That will also give you the sales value of BEP. And this margin of sales units. What is this margin of sales? This is the difference between. So margin of sales